Hello, my name is Nicole, and this video is about understanding notional exposure, the true risk behind your trades. Whether you're trading options, futures, or using other forms of leverage, understanding notional value or notional exposure is critical for managing risk in financial markets. By the end of this video, you'll understand what notional exposure is, how to calculate it for different instruments, and why it matters for your trading strategy. In finance, notional value refers to the face or total value of a financial instrument, such as a futures contract, bond, or option, that is used to calculate payments or determine risk. It's a theoretical or nominal value distinct from the actual market value or cost of the instrument. And throughout this video, we're going to talk about notional value, and we're going to use that interchangeably with the term notional exposure. So simply put, notional exposure represents the total value at risk in a position. It's the full market value of the assets that you're effectively controlling through your investment, regardless of how much capital you've actually committed. So I like to think of it this way. When you trade derivatives, such as options or futures, you're controlling a much larger position than the amount of money you've put down. And notional exposure is particularly relevant in derivatives like futures and options, where it helps in understanding the potential exposure and calculating leverage. To understand notional exposure better, we need to distinguish it from market value. So market value is the current price at which you can buy or sell a position in the marketplace, and it represents what you are actually paying or receiving for that asset. Notional value, on the other hand, represents the total underlying value that your position controls. Due to leverage, the notional value is often much larger than the market value of your position. Now let's take a look at calculating notional exposure for various trading products. Let's begin with stocks. For stocks, the calculation is straightforward. If you buy 100 shares of stock at $50 per share, your initial investment is $5,000, and therefore your notional exposure is $5,000 at the time of that purchase. They're the same because you purchased the asset outright. Now let's talk about calculating notional exposure for bonds. For bonds, the calculation is also straightforward. It's typically the face value of the bond at maturity. Next, let's talk about calculating notional exposure for futures. For futures contracts, the notional exposure can be substantial and is based on the contract size of the underlying commodity or index price. For example, the E-mini S&P 500 futures contract, /ES, has a multiple of $50 per index point, with the index currently trading at 5,600. So the notional value for one contract is calculated by taking 50 times 5,600, giving us a total value of $280,000. That's over $250,000 in exposure from a single contract, even though your initial margin requirement might only be around $24,000. For options contracts, notional exposure gets a little more interesting. There are a few different ways a retail trader may want to think about notional value depending on whether or not they are holding long or short options positions. We're going to focus this discussion on full notional value versus delta adjusted notional value. Let's begin by talking about full notional value for long options. For long options, both calls and puts, full notional value is calculated by taking the contract size times the strike price times the number of contracts held. So for example, if I own 10 SPY 450 strike call options, I would calculate my full notional exposure as follows. The contract multiplier is 100 times the strike price of 450 times the number of contracts held, which in this case is 10. And this would give me a full notional value of $450,000 on that one position. Conversely, a trader may choose to use delta adjusted notional values when looking at long options positions. So for long options, both calls and puts, delta adjusted notional value is calculated as follows. Contract size times current underlying price times the number of contracts held times the delta of those contracts. For example, if the 10 SPY 450 strike call options that I own have a delta of 0.60 or 60, I would calculate my delta adjusted notional exposure as follows. The contract size is 100, and in this case, the current underlying price is 460. I own 10 SPY call options, so I'd multiply by 10, and I'd multiply that times 0.60, which is the delta of those options. And this gives me a notional exposure of 276,000. So you can see that this notional exposure is considerably less than the $450,000 from the full notional value calculation. Now let's talk about short options and begin with talking about full notional value. For short options, both calls and puts, the full notional value calculation is identical to that of long options. So just for review purposes, the full notional value is equal to the contract size times the strike price times the number of contracts. So for example, if I sold 5 380 QQQ puts, I would calculate my full notional exposure as follows. Contract multiplier of 100 times the strike price of 380 times the number of contracts of 5 gives me a notional exposure of $190,000. Now let's take a look at an example where a trader would use delta adjusted notional value for short options. So for short options, again, both calls and puts, delta adjusted notional value is similar to long options. The only difference is it uses absolute values for delta, since short options have negative delta values. So just for review, delta adjusted notional value is equal to contract size times current underlying price times the number of contracts times delta. So for example, if the 5 QQQ 380 put options have a delta of negative 0.45 and QQQ is trading at 390, I would calculate my delta adjusted notional exposure as follows. Contract multiplier of 100 times the trading price of QQ of 390 times the 5 contracts that I sold times a delta of 0.45, and this gives me a notional value of $87,750. Again, that is quite a bit less than the $190,000 full notional value calculated previously. Now, let's talk about calculating notional exposure for futures options positions. And I want to include this in this video because I think a lot of people don't realize the amount of notional exposure they are taking on when they trade futures options. It's like leverage upon leverage. Since many traders are beginning to use E-mini S&P 500 futures options, I think it's a good idea to go through an example of how to calculate notional exposure for this particular product. Let's take, for example, selling 5 ES 5050 puts. I would calculate my full notional exposure as follows. I would take the contract multiplier of 50, multiply that times the strike price of 5,050, multiply that times the number of contracts sold, which is 5. And this gives me a full notional value of $1,262,500. That's over $1.26 million in notional exposure. Even though my initial margin requirement might only be around $50,000, I'm controlling a position that's worth nearly $1.3 million. And that's important to understand. A common risk management practice among experienced options traders is to use delta notional exposure for naked long options positions and full notional value for short options positions. By using delta notional value for naked long options, we get a better representation of actual market exposure since long options have limited downside risk, the premium paid, but the delta gives you a more accurate picture of how much market movement will affect your position. And using full notional exposure for short options positions is definitely a more conservative approach. This accounts for the theoretical maximum risk you could have, particularly with short calls which have unlimited upside risk. For short puts, it represents the full assignment value if the underlying drops significantly. This conservative approach prevents underestimating risk on short options positions, helps to maintain appropriate sizing, provides a clearer picture of worst-case scenarios, and may lead to maintaining a higher cash reserve. Many professional risk management systems and portfolio managers use similar asymmetric calculations to ensure they're not underestimating potential exposure, especially for short options positions where the risk profile is much more complex. So I want to note here that professional money managers use elaborate risk model systems, and that is not what we're talking about here. This discussion is for retail traders and how they might want to think about notional exposure when managing risk in their individual portfolios. So let's talk about calculating notional exposure in derivatives portfolios. Calculating notional value in derivatives portfolios can be seen as somewhat stylistic, particularly when dealing with complex portfolios or when using different conventions for calculating the notional value of individual contracts. So while the underlying principles are straightforward, as you've probably started to figure out, the practical implementation can involve choices about how to aggregate and interpret the notional values of various instruments. Here's why it can be perceived as stylistic. Different contract types. Different types of derivatives have different ways of defining their notional value. Aggregation methods. When dealing with portfolios of multiple instruments, there can be different ways to aggregate the notional values. For example, one might consider the sum of the individual notional values, or a more sophisticated approach that takes into account the correlation between the different assets. Interpretation and use. The interpretation and use of notional value can also vary. For instance, some might use it as a measure of exposure to the underlying asset, while others might use it to estimate potential losses or gains. And finally, customization. In some cases, individuals or firms might choose to customize the calculation of notional value based on their specific risk management needs or internal accounting practices. So again, looking at notional exposure in complex derivatives portfolios can be somewhat subjective and stylistic, even though the general principles are straightforward. Understanding notional exposure is crucial for effective risk management. Here are some key strategies for managing your exposure. Position sizing. Always consider notional exposure when sizing positions. A common rule of thumb is to limit the notional exposure of any single position to a certain percentage of your total portfolio. Diversification. Spread your notional exposure across different asset classes, sectors, and markets to avoid concentration risk. Monitor leverage ratios. Leverage ratios help to assess the leverage and potential risk associated with financial positions. So for example, notional value over market value reveals the amount of leverage an investor is using. And there are other leverage ratios that are out there. If you're interested in this topic, take some time to learn about them and how you might apply them to your portfolio management. And finally, hedging. Use offsetting positions to reduce notional exposure. For example, a portfolio manager with substantial equity exposure might use index futures to hedge against market downturns. So what are the key takeaways of today's video? Understanding and managing notional exposure is essential for successful trading and investing, especially when using leverage from derivatives. Remember these key points. Notional exposure represents the total value at risk in a position. It's often much larger than the initial investment or margin requirement. You want to calculate notional exposure before entering positions, and you want to monitor your total portfolio notional exposure across all positions. And finally, use notional exposure to properly size hedges and manage risk. If you've made it all the way to the end of this video, congratulations, you are a superstar. Remember to like, share, and subscribe if you found this content to be helpful and you're interested in seeing more. Thank you for listening.